Okay, so picture this. You're doing everything right, like textbook right. Every month, without fail, you open your banking app, you transfer $100, maybe a little more if it was a good month, and you put it somewhere. A brokerage account maybe, a retirement fund, one of those apps that rounds up your purchases and invests the spare change. And every time you do it, you feel this little flutter of satisfaction. Like, yeah, I'm one of the responsible ones. I'm not blowing this on shoes or a spontaneous flight somewhere. I'm building something. And then a few years pass and you check your account and the number is fine. It's not bad, but it doesn't feel like the number it was supposed to be. It doesn't feel like the financial independence content you've been consuming for years promised it would feel. And this quiet, creeping doubt starts to settle in, like maybe you're missing something. Like maybe you've been investing consistently, faithfully for years, and somehow still ended up in a trap you didn't even know you were walking into. That feeling, that exact hollow confusion, I think about it a lot. My name is Emmy, and I spend way too much time thinking about money, financial psychology, and why some people do all the supposedly right things and still feel stuck, while others seem to build wealth almost accidentally. And the more I dig into it, the more I find these quiet, undiscussed traps hiding inside advice that everyone agrees is good. Advice that is good, technically, but incomplete in ways that matter a lot. And the $100 a month investment trap is one of the biggest ones, because it preys on exactly the kind of person who's trying, who's paying attention, who opened this video in the first place. By the end of this, you're going to see your investment strategy differently. Not because I'm going to tell you to stop investing, please don't stop investing, but because there's a version of this where your money actually works the way you think it does. And getting there just requires understanding a few things that most financial content either glosses over or completely ignores. All right, let's get into it. Here's the first uncomfortable truth. The act of investing regularly feels so morally good, so financially virtuous, that it can actually stop you from asking whether you're investing well. Think about how much emotional weight we put on the ritual of it, the automatic transfer, the little confirmation notification, the way you can casually mention to a coworker that you invest every month and feel the quiet pride of saying it. There's real psychological satisfaction in being a person who invests, and that satisfaction, it can be enough to make you stop there, to not look too closely at where the money's going, or how much it's actually growing, or whether the vehicle you chose 5 years ago still makes sense. This is what behavioral economists call the action bias, our tendency to feel better about a situation because we did something, even if the something wasn't optimized. And in no area of life does this play out more expensively than personal finance. I knew someone, let's call her Priya, who had been putting $150 a month into a savings account with the word investment literally in the name of the product. She'd been doing this since her mid-20s, felt great about it, had the automatic transfer and everything. When she finally sat down and actually looked at her returns, she realized the account was growing at about 0.3% annually. She'd been doing this for 6 years. 6 years of disciplined, consistent investing that was barely keeping pace with like a third of inflation. She wasn't irresponsible, she wasn't financially illiterate, she just did the ritual, felt the satisfaction, and never looked under the hood. This is the first layer of the trap. The feeling of doing something good is not the same as doing something effective, and the financial industry has gotten remarkably good at packaging the feeling of investing in ways that make you feel the effect without necessarily delivering it. The fix here is almost offensively simple. Once a year, sit down and actually look at your returns. Not the amount you've contributed, the actual growth rate. If you don't know how to calculate that, look up CAGR calculator, compound annual growth rate, and just plug your numbers in. The result might be uncomfortable. That discomfort is worth more than years of comfortable illusion. Okay, this one genuinely frustrates me because it's been talked about in personal finance circles for decades and somehow still doesn't land for most people. Fees. Not the ones on your bank account, not the $3 ATM fee. I mean investment fees, expense ratios, management fees. The tiny sounding percentages that fund companies charge you annually to hold your money. Let's say you're putting $100 a month into two funds. Both are growing at, say, 8% annually, before fees. One charges you 0.05%, the other charges 1%. Over 30 years, the difference in your ending balance isn't a little, it's not even a moderate amount. It's somewhere in the range of $60,000 to $80,000 on just $100 a month, gone to fees. And the absolute cruelest part of this is that the fee comes out silently. You never write a check. You never see a line item. The fund just performs slightly less well every single year, and the compounding effect of that slight underperformance absolutely devastates your long-term returns. It's like a slow, invisible leak in a boat. The boat looks fine until it doesn't. So what do? You look up the expense ratio of every fund you're in, right now, today. If it's above 0.2%, ask yourself seriously why. If it's above 0.5%, you should probably be loudly asking why. There are S&P 500 index funds charging 0.03%. There is almost no justification for paying 20 times that, and yet millions of people are. You can invest consistently, grow your account every year, and still lose purchasing power. Your balance can go up in dollar terms and down in real terms. And if your investment returns are consistently just a little below inflation, you are essentially running on a treadmill. Working hard, going nowhere, feeling like you're moving. We talked about inflation in a vague, hand-wavy way for years, and then 2021 and 2022 happened, and suddenly inflation wasn't abstract anymore. It was groceries, it was rent, it was the electric bill. Even normal inflation, the 2 to 3% we were all assured was healthy and fine, quietly destroys low-yield investments over long periods. The S&P 500 has historically returned somewhere around 10% annually before inflation, or roughly 7% after. That's the benchmark worth knowing. If your investments are consistently returning well below that over long periods, that gap is costing you real money in real time. Okay, this is the one that I think hits the hardest and gets talked about the least. $100 a month is a great starting point. It really is. Getting into the habit of consistent investing, even at small amounts, is legitimately important. But here's what nobody tells you. For a lot of people, that $100 a month quietly becomes the permanent number. Not because they can't do more, because the number never gets revisited. Life gets busier, the transfer keeps running automatically, and years pass. $100 a month for 30 years at 7% annual return gives you roughly $121,000. That sounds okay, right? Now, $200 a month gives you $243,000. $500 a month gives you $608,000. $1,000 a month puts you over $1.2 million. The difference between financial comfort and financial freedom for most people is not which stocks they picked, it's how much they put in. There's a concept in behavioral finance called Save More Tomorrow, developed by Richard Thaler, who won a Nobel Prize partly for this work. The idea is simple. Instead of asking people to save more right now, you ask them to commit to saving a percentage of their future raises. You can do this yourself. Whenever you get a raise, any raise, commit to putting at least 25 to 50% of that raise increase into investments. You never had that money before, you won't miss it. And over time, your contribution grows with your income, rather than staying frozen at the number you picked when you were 24 and just trying to feel like an adult. Where you put your investment money matters almost as much as how much you put in and what you invest in. A surprising number of people are investing in the wrong type of account, not wrong in an illegal sense, but wrong in the you're paying taxes you didn't need to pay sense. In the US, these are things like the 401k, the IRA, the Roth IRA. The government gives you a tax benefit in exchange for leaving the money in until retirement. A lot of people put their $100 a month into a regular taxable brokerage account, which is fine, but if they're not maxing out their tax-advantaged accounts first, they're leaving free money on the table. And then there's the employer match. Oh, the employer match. An employer match is a 50 or 100% instant return on your investment before the market does anything. There is no investment vehicle on earth that competes with that. For most people, employer-matched 401k first, Roth IRA second, then taxable brokerage if you have more to invest. There's a version of diversification that feels sophisticated and feels responsible and is actually kind of pointless. I call it diversification theater. Someone might have $100 going into 5 different ETFs. They feel diversified. They're in different funds. But if 4 of those 5 are basically tracking the same large-cap U.S. stocks, you're not really diversified. You're just paying more fees for the illusion of spreading risk. If someone is diversified across 10 different individual stocks, all in the same sector, say tech, that's not diversification. That's concentration dressed up in a blazer. Real diversification means your investments behave differently under different economic conditions. Domestic stocks, international stocks, bonds, not just different fund names covering the same underlying assets. You don't need 20 positions, you might need 3. There's a belief, often subconscious, that if you just wait for the right moment, you'll invest more effectively. The market feels high right now. There's an election coming up. I heard there might be a correction soon. I'll wait until things settle down. It feels rational. It feels like prudent caution. And it is almost always, statistically speaking, a mistake. Time in the market beats timing the market. Missing just the 10 best days in the market over a 20-year period can cut your returns roughly in half. And those 10 best days often happen in the middle of scary, volatile periods, when the urge to wait is the strongest. A market downturn is a sale. Every share costs less. If you invest $100 in a down market, you buy more shares than you would have in an up market. Pausing contributions during a correction is mathematically one of the most costly things you can do, but emotionally it makes perfect sense, which is why so many people do it. The antidote is boring and unglamorous. Automate. Set it and don't touch it. Let the boring robot move the money every month regardless of what CNBC says is happening. Okay, last section before we wrap up, and this is the most human one. There's a phenomenon where people lock their financial identity into an earlier version of themselves. They started investing a certain way, at a certain level with certain assumptions, and because that version of them felt like they figured it out, they stop questioning it. The $100 a month investment trap isn't just a math problem, it's an identity problem. If you think of yourself as someone who invests $100 a month, that becomes the story, and updating the story requires confronting the fact that the earlier version of you might not have been fully right. Humans really don't like updating their self-image. It's related to cognitive dissonance, to loss aversion, to about a dozen other documented psychological phenomena. It's not weakness, it's how we're built. Financial growth requires identity growth, the willingness to look at your past self and say, I was doing okay with what I knew, and now I know more, so I'm going to do better. So, let's bring this home. If you've been investing $100 a month and feeling that quiet, nagging sense that it should be adding up to more, that feeling is worth listening to. Not because you did something wrong, but because there are probably layers to your investment approach that haven't been examined yet. And examination costs nothing. Avoidance costs everything. None of this requires you to become a financial expert. Most of it just requires a few honest hours, maybe once a year, where you actually look at your situation with fresh eyes. The people who build genuine, lasting financial security are mostly the people who set up good systems, reviewed them periodically, kept learning just enough to keep improving, and didn't let comfortable feelings substitute for actual results. You are clearly someone who pays attention. You watched this. You're thinking about this. That matters more than you know. Financial change isn't usually dramatic. It's usually quiet. A slightly better account, a slightly higher contribution, a fee you stopped paying, a habit you built. Repeated over years until one day you look at your balance and it actually looks like the number it was supposed to be. You can get there. You probably just need to look under the hood a little more often. Thanks for being here.